Hi traders, this is Dr. Barry Burns, and today we continue our video series on market cycles. And today we talk about the cycles of expansion and contraction, or as a lot of people call it, volatility cycles. As you know, the market increases and decreases in volatility, and there are actually chart patterns that are based around that. So, for example, we've talked about the market going up, and you have a cycle where the market goes up and down and up and down and up and down. And when we show this type of diagram, really what we have is a pretty even volatility. In other words, volatility has to do with the range that the market moves. So that range is, roughly equivalent to that, roughly equivalent to that. So these half cycle ups are roughly the same. Same thing with the half cycles going down. They're pretty close to the same range. In other words, the market covers the same number of points coming down. This happens to be a S&P chart. It's actually the Spider's weekly chart. Doesn't matter what chart it is. This works for stocks. It's true of futures and Forex and commodities and really most all markets. So that would be a very typical approach to seeing cycles, and that is true. But another element of cycles is, as I mentioned, volatility, where the range will vary. So in other words, the market can go up, come back down, and then go up a lot, and then it could come back down a lot, and then it can start doing something like this, and then go back up. And so what you're seeing here is the range here is very different than the range here. And then the market goes into a consolidation period where the ranges become very small, and then it increases again. So this is pretty typical. And what we see is we get an increase in volatility, followed by a decrease in volatility, and this can take many different forms. And then we get another increase in volatility, and that volatility has nothing to do with direction. The market can be going down on big volatility. And then we go back into contraction mode again. Contraction meaning little volatility or small ranges in the market. As I mentioned, there's price patterns that are based around this. So for example, a triangle pattern, we're making lower highs and higher lows. And so a triangle pattern, symmetrical triangle pattern, is a low volatility pattern. We're coming out of high volatility or expansion, going into contraction. And that can be different types of triangles. That one's a symmetrical. This could be an ascending triangle, descending triangle. All of them are contraction patterns. Could also be a wedge formation. And again, we're getting low volatility. Volatility is decreasing. So all these patterns are decreasing volatility or contraction patterns. You can get also a megaphone, or what's called sometimes an expanding triangle pattern. And this would be an expansion pattern where volatility increases. Now here you're actually getting higher highs and lower lows at the same time. So the market is directionless. It's not really going up or down, net up or down, but it is increasing in range as time goes on, and therefore increasing in volatility, and this is an expansion cycle. Now, one of the easiest ways to visually see these expansion-contraction cycles is with Bollinger Bands. It's a nice tool, and it just kind of makes it pop out. And one of the things to watch for in Bollinger Bands is as the market goes, in this case, up or increases in volatility, get into an expansion cycle, quite often, the Bollinger Band that is on the opposite side of the directional move will actually move away from it. and then it always turns and comes back to it. So one way to know whether you're in an expansion or contraction cycle is just to look at the distance between the Bollinger Bands, and you do it vertically. Don't try to do it like this. Do it vertically on your chart, and that will show you you're in an expansion cycle, and then the market starts to contract here. See how the Bollinger Bands come closer together. Then it expands again, and then it contracts again. And this shows you that cycles, volatility has a cycle to it. Expansion, contraction, expansion, contraction. Okay. Same thing here. As we start to expand to the upside, the Bollinger Band on the opposite side of the move actually starts moving down, creating more distance between the Bollinger Bands so that we realize we are in an expansion mode. And then they come back closer together, get back into a contraction mode. And this will continue to repeat over and over. Bollinger Bands spread apart in opposite directions, expansion, contraction. Again, expansion. So that's why it's a cycle, is that it keeps cycling between expansion and contraction. Here we go again. Expands here, contracts, expands, and over here, contracts again. Okay, there's your contraction. Expands, contracts. So one of the problems that a lot of people have with expansion and contraction cycles is they will do, for example, a scan in the market, or even for day traders. This is an issue as well. And they think, okay, I want a market that's really moving, so I want a high volatility market. I want a market that has good ranges to it. And so they'll do a scan, or they'll look for a market or wait for their market to start making a big move like this. And they'll say, great, we've got a very volatile market here, high volatility, big ranges, big moves. So now I'm going to come up here and I'm going to short this cycle high, combining expansion-contraction cycles with up-down cycles, which is what we do. So, but what happens is they get in, they go short, and then what? The market goes into contraction mode. And so then they're wondering, well, I thought this was a volatile market. I thought this market had big ranges to it. And of course, they're doing it exactly wrong. Their timing is exactly perfectly incorrect. What they really should be doing is scanning for markets that are in contraction mode, knowing the cycles, and that after contraction comes expansion. If you get into a market when it's already expanding, you're getting in right before it's about to go into contraction mode. So you really want to get in when it's in contraction mode, and then catch the big breakout for the big move. And there it goes. Boom. And as you can see, then we go right back into contraction and even more contraction here. Contraction will last for a various number of up-down cycles. But then this again would be a good time to start looking to get in. Now, like most things, these expansion-contraction cycles alone are not enough to trade with. You need to mix it with your other energies, such as momentum and trend and multiple time frames. But that's the way to analyze these expansion-contraction or volatility cycles.